So the IRS classification of digital assets. Digital assets are considered property for tax purposes. There you go. It's the first thing on the page. It's bolded. It's incredibly important, and you need to knock that into your head over and over and remember that. Um, Digital assets include cryptocurrencies, NFTs, and other blockchain-based assets. Basically anything digital, really. And they're all considered to be property by the IRS. This has tax implications because it means that we can examine all sorts of crypto transactions through the lens of property taxation and apply regular property tax principles to those transactions. Specifically speaking, it means that most transactions are going to be subject to capital gains and losses, or at least have a capital gains component to them. The importance of compliance. Understanding this classification is crucial for accurate tax reporting and compliance with IRS regulations, because it tells us how to handle basically everything that's available to do in the crypto universe. We don't have a lot of specific guidance at the transactional level. There is some in the FAQs. There's been a couple revenue rulings that discuss a couple of specific transactions, and we'll talk about those. But there's a lot of open-ended stuff that's going on right now. And kind of the point of all of this is that we use the crypto is property mantra to examine whatever transactions are taking place and classify them appropriately from a tax perspective, so that we can then put it on our tax return in the appropriate place. The guidance documents, the big one here, the document that kicked it all off was Notice 2014-21. We'll discuss that in a little bit more detail, but that is where we get this classification of digital assets or crypto assets being property for tax purposes. And again, I'm sorry, I'm sure you're already sick of me saying that. I'm only going to say it 12 or 15 more times, but it is important to understand. What are some taxable events for digital assets? The list is long. This list is by no means exhaustive, because there's a lot of transactions that are available to partake in the crypto universe, and it wouldn't be a good service to anyone's time to list them all here. But we'll go through a couple of the basics. All trades, whether crypto to fiat or crypto to crypto trades, are reportable taxable events. Using digital assets to pay for goods or services is considered a deemed trade. So in addition to the expense, you're going to have a capital gain or loss component on that trade based on the value of the crypto that you spent compared to when you bought it, essentially, or when you acquired it, however you did. Income generation, which includes mining, staking, or payment for services. It also includes things like gaming. That's getting very popular now. Crypto gambling, all sorts of stuff like that. Excuse me. There's an innumerable number of ways to earn income in the cryptoverse, as many as there are in the normal economy. And all of those are going to be some sort of taxable event. We just have to figure out which kind. And then finally, DeFi transactions. DeFi, as a term, as a buzzword, decentralized finance, everybody knows what it is. But for tax purposes, it doesn't really mean anything, because it encompasses such a large number of different types of transactions. When you think about what DeFi is, really it started as a way to kind of mimic traditional financial transactions in the crypto universe. It's morphed into something else entirely now. But the fact of the matter is, there's things like, lending. There's things like with liquidity pools, which is essentially the same thing as market making from a traditional financial standpoint. All sorts of stuff like that. And so the term DeFi from a tax perspective doesn't really help us to determine what's going on, but it is important to understand that most DeFi transactions that you undertake are going to have some sort of taxable component to them. Non-taxable events, this is going to be your buy and hold. Anything you buy with fiat and hold for an indeterminate amount of time, that's not going to be taxable. As well as transfers among wallets that you own or accounts that you own. That's akin to, taking your wallet out of your left pocket and putting it in your right pocket. Nothing's really happening. So that's not a taxable event. The takeaway here from this slide is that just about everything that you can do with crypto except buying crypto with fiat and holding it, or internally transferring in my wallets that you own, likely has tax implications. We're far removed now from the old thinking that, you know, maybe you could 1031 this stuff. Obviously, that's not the case. Thinking maybe you could just not report this sort of stuff because the IRS doesn't know about it. That's not the case anymore. Pretty much everything you do is going to be reportable, and there is going to be a taxable component to it. Oops. So now let's get into the official guidance that we have so far. And it all starts with Notice 2014-21. This was published in March 2014, so we're coming up on the 10-year anniversary now. And it was the IRS's first attempt to assert authority over crypto transactions. Broken down into 16 FAQs, covering very basic transactions in the crypto space, including trading, spending, and earning. Those are all things that we wrote on the first page or on the second page of this presentation. And those are kind of the basic types of transactions that you can do with crypto. The biggest takeaways here, you guessed it, crypto is property. Crypto is property. That applies to everything that we do in this space, and it's important to know that. And finally, it's retroactive, which means that it applies to all dates before and after issuance of Notice 2014-21. So anything that's ever happened ever since, you know, Satoshi hit go is considered to be, you know, under the auspices of this notice and reportable to the IRS. From there, we go to the FAQs on virtual currency transactions. This is kind of a built around Notice 2014-21. It's kind of a beefing up of the 14 or 16 FAQs that were included in that notice. Now, as of the time of this presentation, it consists of 46 different FAQs regarding crypto transactions. The last update that I know of was in June 2021. There's no clear organization, but it's a web page, so it is searchable. There's a couple of additional topics that are covered, including gifts, crypto compensation for employees, charitable contributions, as well as some basic information about where to report some of this stuff on your tax return. And I just want to take a look real quick. This is a good opportunity to do it. If you guys can still see my screen, hopefully. This is the IRS's digital assets landing page. Could somebody just type in the chat? Can you? Okay, good. Thank you. Thank you, Brandon. This is the IRS's digital assets landing page. Go to irs.gov. Just type digital assets in the search box. It'll come up. But this is kind of an overview of how the IRS sees digital assets. And by digital assets, we mean crypto. I kind of use crypto and digital assets interchangeably, although I guess technically they are different. For our purposes, we could say crypto is digital assets and vice versa. But this kind of outlines their thinking of what digital assets are, what the tax consequences may be. And you can see that they've got listed some transactions, including, but not limited to, all the stuff that we already talked about. And then finally, there's a section on guidance and publications. This is a listing of the announcements that the IRS has already published. You can see they talk about the 6045 regs, the proposed regs. And then finally down here, you can link to all the different notices, 2014, 2023, the FAQs themselves, which is what we're talking about right now. So let's go ahead and look at that. This is the FAQs, the frequently asked questions on virtual currency. You can see as you look through, there's not a whole lot of order to it. It is kind of, smushed together, a whole lot of different concepts, but it's searchable, right? Because it's a web page, so we can do Control F and find, mining or something like that. So it is a good resource to use if you've got a question. It is very basic, and it doesn't really cover anything that's happened since really the first part of 2021. So a lot of the newer stuff, a lot of the newer DeFi protocols and platforms and stuff like that, there's going to be nothing mentioned about things here. It doesn't mention liquidity pools, which are wildly popular. It doesn't mention anything around, some of like nodes as a service, which I think is pretty much done now after the last, bear market. But anyway, the point is that this is a great resource, but it is very, very basic. So don't expect too much, but if you have some questions about kind of the broad concepts of it all, this is a good place to go. So we'll go back to our presentation here. Hopefully it doesn't start over. Yeah, we're on the right page. So the question that you always get when you think about things like FAQs, it's not official guidance, right? It's not authoritative guidance. So can you rely on it to assert a position on a tax return? And the answer is maybe not, but the IRS has come out and said that reliance on the FAQs can substantiate reasonable cause penalty for abatement. Abatement of the reasonable cause abatement of various penalties. What that means is that if there's a transaction that you need to report on your tax return, you go over to the FAQs, look it up, and the FAQ says, report it this way. And then you do report it that way. And then some later date, the IRS backtracks and says, no, we have to report it this way now. It's not going to change the fact that there's still going to be additional tax due, or there may be additional tax due on the way that you reported that transaction initially. But in terms of the penalties that they'll assess on that underpayment of tax, the FAQ itself can be relied on as reasonable cause for the abatement of those penalties. So they say that they're going to update the FAQs, consistently over time as new things come out, as new new knowledge is gained about the space. And that hasn't really happened in the last couple of years. But if there is any doubt, if you are relying on the FAQs to substantiate a position on a tax return, or you want to rely on them to get reasonable cause abatement for penalties, you need to print it out. You need to print the FAQ out at the time that you're relying on it, so that you then go back to it and say, this is what it said on February 22nd, 2024, when I filed my tax return. Now it's 2026 and I get a CP 2000 notice in the mail. I could pull up the old FAQ and say, this was it at the time, so I'm not going to pay any penalties. And the IRS should accept that, which is quite a nice thing. Okay. Revenue Rule 2019-24. This was an incredibly narrow holding, but let's talk about it because it is related to crypto. The issue was very basically, does a taxpayer recognize income after a hard fork if the taxpayer receives or does not receive airdrop crypto? And of course, no great surprise here, the IRS held that the income is recognized if a new crypto is received. No income is recognized if no new crypto is received. Not really sure why they went ahead and put a revenue ruling out on this one. Like I said, it is very, very narrow. It's a very specific set of circumstances. And it's the same exact thing that already appears in frequently asked question number 23 on the FAQ page that we just talked about. So, I don't know what the sense was there, but nevertheless, it is issued guidance. So it serves us to talk about it. If you have any questions about hard forks and an airdrop afterwards, you can look to Revenue Ruling 2019-24. Next, we'll go to Revenue Ruling 2023-14. This was a big one when it dropped earlier this year. I believe it was late summer, maybe it was early fall, I'm not sure. But this clarifies the IRS position taken in the Jarrett case. If you remember that case, if any of you guys follow this stuff, that case involved a couple that had been staking Tezos, XTZ. They had filed their tax return and claimed the staking income, paid appropriate taxes on it, and then went back and sued for a refund, essentially, in district court. This revenue ruling holds that staking rewards should be recognized as income in the year in which they're received, and received, of course, means dominion and control, right? Constructive receipt. And that the income is included at the fair market value at the time of receipt. So you need to essentially track this stuff. When we talk about things like, staking protocols or staking pools or things like that, it becomes incredibly burdensome because some of these pools pay out, every 6 minutes or every hour or something like that. So you can imagine if you're doing it over a full year, that's an incredible number of transactions. and you have to accurately track all those and know what the value of the staked crypto is when you receive it at all those separate time periods, and then add them up and, put them on Schedule 1 of your tax return. This applies to all staking rewards received, whether from staking pools, exchanges, and directly from running a node. And again, it's kind of a repeat of the general tax principle, right? Crypto's property, and the receipt of property is generally considered an income event. So if you receive a crypto from staking, you need to report that in your income. There's all sorts of, legal questions around this, whether the big issue in the Jared case itself was that the taxpayers' lawyers were arguing that the production of staked crypto essentially is creating new crypto, right? So it's more akin to a farmer raising crops or an artist painting a painting or a fresco or something like that, right? Which is to say that neither of those two people pay tax when they receive it, right? If a farmer plants corn, the corn grows, he harvests the corn. He doesn't have income when he harvests the corn. He has income only when he then sells the corn. But that implies, difference of marketability and things like that, seasonality. The fact of the matter is that most of these cryptocurrencies that you can stake and earn money from staking or earn crypto from staking are actively traded and very tradable, so that there's no real distinction made. You could take that, you could receive the staking reward right now and then immediately turn around and sell it for another crypto or for fiat. And so it's a question of accessibility, really. And in any case, that's, beyond the scope of a talk like this. I'm a CPA. I do a lot of tax returns and I'm focused on compliance. So the IRS says that you need to report staking income. That's what I'm going to go with. If the lawyers want to take it on in court and get that rule changed, by all means, they could do that. But until then, we're kind of bound to this. When staking rewards are received, they are considered income. That's the thing to remember about this. Next slide. Notice 2023-27. This wasn't actual guidance. It was kind of proposed guidance. And it was all about NFTs and what they meant, essentially. And it signaled that the IRS was intending to issue authoritative guidance on NFTs. And the big thing here is that the IRS says that they're going to apply a look-through analysis to determine if certain NFTs are considered collectibles. What they mean here is, what does the NFT represent? And if the NFT represents some sort of art, is that art considered, a work of art within the definition of the tax code that applies to collectible? And the holding was that maybe it will. And it discusses prohibited transaction treatment of collectibles inside retirement accounts like IRAs. We all know that if you have a self-directed IRA, you could buy anything you want with that money, but you shouldn't buy anything that's deemed to be a collectible, because that's a prohibited transaction. It counts essentially as a distribution. So if you buy, a piece of fine art with IRA money, it's essentially the same as taking a distribution for whatever that amount of money that the art cost was. And they're saying that it's going to apply the same way to crypto. If the NFT denoted a work of art, whether that art be actual physical art or digital art, which many NFTs are, that might count as a collectible, and it might be a prohibited transaction when it occurs inside of a retirement account. The big thing here was that nothing was actually written in stone. The IRS, it was really they were seeking public comment on whether or not this was a good idea. I'm not sure what the results of that were, but we haven't heard anything else from that since sometime this summer, I believe, is when that all came out. Okay, next slide. That covers pretty much all the guidance that we have from the IRS, at least the published guidance. And so now we're going to kind of move into what the reporting requirements are. And like I said, we're not going to spend a whole lot of time here because, as you know, there's any number of different transactions that can be undertaken in the crypto universe. And they all have different tax implications. They all have different reporting requirements. But we'll cover some kind of basic ground rules here. And the first one is that trading transactions, buying and selling crypto, or rather selling crypto, whether crypto for fiat or crypto for crypto, as we talked about earlier, those transactions have to be reported. Individuals have to report all transactions. Businesses may be able to consolidate transactions and file a consolidated 8949 or a lesser Schedule D if they qualify. There's all sorts of restrictions around that. It's important to note that spend transactions will have a capital gain component. As we talked about earlier, spend transactions, what that means is using crypto to pay for things. And it sounds kind of, it's becoming more and more common. When we first started this, it was kind of unique. There weren't a whole lot of merchants that accepted crypto payments. That's kind of, turning a corner now. And especially now, there are things like crypto debit cards, which will allow you to, immediately spend your crypto as cash at, various merchants. Anytime you spend crypto on goods or services, you're going to have the spend itself might have a taxable component, not if you're an individual per se, but if you're a business, it might be a business expense. But there's also going to be a capital gain or loss component to that transaction based upon the change in value of that crypto between the time that you spent it and the time that you acquired it. That's because, as we know, and we've said 100 times already, crypto's property, right? We're going to have the property transaction rules will apply here. When you buy and sell property, you've got capital gains. Earnings transactions may appear on various forms and schedules, right? Individuals may report things on Schedule 1, right? Schedule 1 is just kind of a consolidated other income statement. That may be where you include things like staking rewards, or maybe rewards from some of the exchanges and things like that. Schedule B, generally that's interest and dividends, right? So if you're doing any sort of DeFi lending protocols and you're earning interest, you may want to report that on Schedule B. Schedule C, we all know that's self-employed, small business, things like that. If you're earning crypto by providing services, you may well have a necessity to file a Schedule C. It's important to note that there are a lot of different ways that you can classify some of this stuff, and regular tax rules apply, right? So when you're talking about things like running a node or mining, you're going to run into issues around whether you're doing it as a business or as a hobby. And that's going to be, straight to, Section 183 to determine what those rules are. And it could vary person by person, right? Somebody might buy a couple of these ready-made miners, and it's not really a thing that they put a lot of time or thought into. Another guy might turn his whole garage into a mining rig. We've seen that a couple times, and it's much more business-like. And so you're going to have to examine these crypto transactions through the lens of general tax principles to determine where they're properly reported. That is to say that, this is just some kind of general guidance. And the same thing is backed up by different questions in the FAQ that's available online. But you're going to need to examine everything at the transactional level, determine how it applies to the specific taxpayer whose return you're working on, or your return, if it's for your own return, and determine where to report that. Schedule C, Schedule 1, that's a facts and circumstances case that you're going to have to determine for yourself. Business versus hobby treatment, things like that. That's got all sorts of other implications because we all know, hobby expenses no longer deductible, at least until next year again. Income earning transactions for businesses are likely going to be in the top section because that's where they report all the income that they earn, right? Whether that be, ordinary income or interest income or capital gains, things like that. For most business returns, it's right there in the top section. The exception being pass-through entities, where that might just appear on Schedule K. All right, let's keep moving. Let's talk about the infrastructure bill. The infrastructure bill, when it passed, was big news. It was, I think it was 1,200 pages. And on, way at the back, there were like 6 or 8 paragraphs that were dedicated to crypto. The big thing here was that the infrastructure bill mandates 1099 reporting beginning in 2022 for all brokers, which is defined as any person who, for consideration, is responsible for regularly providing any service effectuating transfers of digital assets on behalf of another person. This is a hugely broad definition, and it pulls in pretty much anybody with a hand in the crypto space, right? Aside from just the exchanges themselves, what we think of as traditional brokers, there's implications for miners, stakers, software developers, wallet providers, pretty much anybody who's affiliated in any way with the crypto economy is kind of pulled in under this dragnet definition of what a broker is. So immediately people realized that this was going to be a huge issue. There's numerous amendments floating around Congress right now to narrow the definition. Most have stalled out. We'll talk about one that's attached to the Lummis-Gillibrand bill if we have a little bit of time later. But it's important to know that almost everyone universally knows that this definition is overly broad, and there are attempts being made to change it, to narrow it. And it's also important to know that if you read the first bullet point, the 1099 reporting was supposed to begin in 2022. It's since been delayed. That's going to be starting next year. So this is one of those things that has, the IRS or Congress or whoever it was has kind of kicked the can repeatedly down the road because they know that it's going to be an administrative burden. It's going to be a real hassle. If you talk about the overly broad definition of what a broker is, the IRS has estimated that will account for 8 billion or 6 billion 1099 forms. That's billion with a B that are being produced, in addition to all the 1099 forms that they get every year anyway from traditional finance. So it's a huge administrative burden, and it's one that a lot of smaller crypto companies probably can't account for and probably can't make work because it is just an added cost. Add to that what's required to be reported on these 1099s, and it really doesn't make sense from a crypto perspective because most of what happens in crypto is anonymous. You're not doing a lot of KYC, know your customer stuff around people creating accounts on these DeFi platforms. Up until recently, most exchanges weren't doing it either. It was only a couple of years ago that the big US exchanges started making you verify that you're a real person. And now I think they're at the point, I haven't opened an account in a long time, but I know now that they're requiring you to, take a picture of your driver's license to prove that you are who you say you are. That is all very, very recent. And so anything that happened prior to, just a little while ago, they're not going to have a lot of customer information that they can even report. So this whole 1099 thing is a real big mess. And we'll talk a little bit more about that in a few minutes. We're going to talk about the proposed regs under 6045, which deal with the 1099 reporting. But let's move on to the next thing, which is continuation of the discussion of the infrastructure bill, specifically Section 6050 Cap I, which was amended by the bill to include, quote, any digital asset in the definition of cash. If you will remember, 6050 Cap I is where cash reporting rules are. All crypto transactions over $10,000, if in the conduct of a trade or business, are subject to the Form 8300 reporting rules. These are the traditional bank forms where if a bank or a financial institution takes in cash of more than $10,000, they have to report that to FinCEN. It's an anti-money laundering thing. It's a anti-terrorism thing. But it's important to note in the crypto space that it's nearly impossible because, again, like we mentioned earlier, there's not a whole lot of KYCing going on because the nature of crypto calls for anonymity. It's going to be a huge administrative burden for legitimate exchanges. It's going to be almost impossible to comply with for smaller actors, as we've already said. If you talk about, we handle in our practice, we do a handful of NFT artists and NFT groups and things like that. And when they release a new NFT, they're not gathering name and social security number and address on all these people who are buying it. They just kind of put it up and people, throw ETH at them and that's how the transaction goes. So a lot of these smaller guys are not even going to be able to comply even if they want to. It's going to be incredibly cumbersome for DeFi users, for NFT sellers, and things like that. But it's important to note that the IRS has delayed the enforcement pending issuance of regulations. That just happened recently, probably, I don't know, 3 weeks ago, maybe a month ago now. But if you remember at the beginning of the year, crypto Twitter, Discord, everywhere was blowing up that everybody thought that they were going to have to report all sorts of different transactions on Form 8300. The first takeaway was to remember that 8300 only applies in the conduct of a trader business. So person-to-person transactions wouldn't fall under the purview of that. But then the IRS kind of gave us an early birthday present when they said that they weren't going to enforce it until they could finalize regulations around it. So nothing to worry about right now, but it's going to be an issue in the future whenever the IRS gets around to finalizing regulations. So while we're on the subject of regulations, let's talk about the proposed regs under 6045. These are the broker reporting regs that we just talked about that are mandated in the infrastructure bill. They were published last August. They go into effect next year, which means the reporting will begin next year. And the regulations assume that the overly broad definition of broker will stand and include exchanges, wallet providers, digital asset payment providers, crypto kiosks, pretty much like we said earlier, pretty much anyone with any sort of a hand in the crypto economy is going to be roped into the definition of broker. We get from these regulations, actually before these proposed regulations, the IRS circulated a draft form, what they call a 1099 DA. DA stands for digital asset, but it's very similar to the standard 1099B form that you get from any sort of brokerage. Reports date of acquisition, date of sale, gross proceeds, cost basis, description of asset, all that good stuff that we're all familiar with from, the various brokerage statements that we've seen over the years. But the big thing there is that there's, due to the nature of crypto's a self-custodied asset for most of us who use it regularly. There are some people who exist only on exchanges, but, for those of us who actually believe in this stuff and who actually participate regularly, self-custody is one of the key tenets of the whole crypto economy. And so you can imagine if you go onto an exchange and you buy, 1 ETH right now, and then you pull it down into a cold wallet, and then you wait a while, and then you send it to, another exchange a year from now. There's no information exchange that happens amongst those various steps, right? Particularly the step where you hold it yourself. In the traditional financial world, we've got the ACAT system, right, which is the clearinghouse and information transfer system, which the various brokerages use to transfer things like cost basis information. So if you have an account at Fidelity, you buy a share of ABC Corp, you want to move that share of ABC Corp over to a Schwab account, you could do that. And then a couple weeks later, ACATS will catch up and Schwab will know what you paid for that share at Fidelity. Nothing like that exists amongst the crypto exchanges yet. I've heard whispers of something being worked on, but I don't know how much detail it'll go into. And certainly, like we said during all this, for the smaller players, that's going to be very cost prohibitive for them to even begin to implement a system like that where they can transfer cost basis information among different providers, which is a very long-winded way of saying that most of these 1099s are going to be wrong. They're required to report cost basis, and there's almost no possible way for them to know cost basis unless someone is siloed in one exchange. So if you have a Kraken account, you go on Kraken, you transfer in $100 and you buy $100 worth of ETH, and then you leave it on Kraken. Later on, you sell it. Of course, Kraken's going to know what you paid for that ETH. But if you're not siloed on one exchange, if you're moving this stuff around, if you're ripping it down into cold storage, if you're putting it on DeFi protocols, if you're doing things like liquidity pools, stuff like that, I mean, it's not hard to see how you can rack up a very large number of transactions where you're essentially transferring the same crypto over and over, and then later you put it onto another exchange and sell it. How are you going to get the cost basis? It's it's next to impossible to figure that out. That's what we use, in our firm. That's what we use software for, to kind of track all this stuff. But functionally, for the exchanges and for the quote unquote brokers to report this stuff correctly, they're going to need to warehouse an incredible amount of information and know how to apply that before these forms will be anything but correct. And so we think when these 1099 forms, whether it be the 1099-DA or the 1099-B, whenever those start to roll out next year, we expect almost all of them to be wrong. Okay. A couple other things. Fees. Transaction fees are split evenly between the asset sold and the asset acquired. And finally, the basis allocation method applies at the account level. So we'll essentially, if you're familiar with crypto tax software, we'll have to do what's known as depot separation, whereby you segregate assets into whatever respective account they were purchased in or acquired in, and leave them there. And that's how you can apply your basis allocation method, whether it's, FIFO or one of the specific ID methods. Let's move on. How are we doing on time? We got a few minutes left. The wash-loss rules. Currently, the wash-loss rules don't apply to crypto trades because crypto is not a security. Does anybody remember what crypto is? That's right. It's property. Good job, everybody. Crypto is property. There's legislation aimed at ending the wash sale loophole. And I put loophole in quotes because it's not a loophole. It's just a rule. It was included in both the Securing a Strong Retirement Act and the Build Back Better bill. Say that 10 times fast. Both of those are stalled in Congress, probably won't see the light of day. Most recently, wash loss rules or ending the wash loss loophole was a clause included in a wildlife protection bill that was aimed at expanding wolf habitats in Alaska. So you could see that, we're probably not going to get a lot of crypto regulation or legislation through, sort of big omnibus crypto bills. It's probably going to be a lot of little things that are tacked onto other bills that have a good chance of passing. The wolf bill did pass, but before it did, they knocked off the wash loss rules. So as of right now, currently, wash loss rules don't apply to crypto trades. You could sell at a loss, buy right back, and recognize the loss. That's perfectly legal. It's important to note that whenever they do close the loophole, again in quotes, it's not going to apply to assets with different ticker symbols. So if you, just like in stocks, the substantially similar rule has taken to mean, assets with the same ticker symbol. All right. Now we'll talk briefly about some proposed legislation, some of the things that are kind of floating around in Congress. Legislation is important, and it's kind of outside the purview of this talk, because this talk is about the IRS perspective on digital assets. But it's important to note that the IRS doesn't write the tax code. Congress does. So we need to pay attention to what Congress is doing in terms of crypto, because they're going to pass bills into law that alter the tax code. Then the IRS is going to come behind them and write regulations on all this stuff. Or, pass down notices or whatever, guidance in whatever form it takes. But it's all going to stem from the tax code and Congress's changes there. So the Lummis-Gillibrand bill was meant to do a lot of things. First and foremost, it was going to move cryptocurrencies under the umbrella of the CFTC and away from the SEC, where Gensler's hands can't touch it. It was going to clarify the meaning of broker to exclude a couple of categories, including wallet providers and software developers, which is a good start, which, in my opinion, it should be a lot narrower than that. But at least we're narrowing it down. We're not getting everybody caught up in the dragnet. Stable coins would be required to be 100% asset backed. There's disclosures to the SEC for companies raising funds through ICOs. Importantly, at the individual level, the bill aims to exempt small transactions from taxation, and in the bill itself, it was written that transactions under $200 would not be subject to taxation, which would mean that you could essentially spend cryptocurrency like currency. You could buy your coffee at Starbucks without having to worry about how that would affect your Schedule D on your 1040. And finally, there's clarity around donated assets, right? One of the big things that we see a lot in our practice is that people will donate large amounts of crypto to, the charity of their choice, completely unaware of the rule, because crypto, again, is property. We all know that by now. The rule is that any donation greater than $5,000 has to be backed up by a qualified appraisal. Nobody knows that. Nobody gets the appraisal done. And so that's always a big issue at the end of every year when people tell us that they donated crypto to charity. The Lummis-Gillibrand bill would essentially equate the treatment of donated crypto with the treatment of donated securities, which is to say that you could go by the market price at the time of the donation. You wouldn't have to go through the rigmarole of getting a qualified appraisal and things like that. It would simplify the whole process. Virtual Currency Tax Fairness Act. This one's short and sweet, kind of a carryover from the Lummis-Gillibrand bill, but it was a Senate bill that wanted to exempt small transactions under $50 from tax reporting requirements. Same concept, you could buy your dinner, you could buy your coffee with Bitcoin or ETH or whatever, and you wouldn't have to report that on your taxes. Again, these are all bills that are circulating in Congress now, have not been passed yet. So I don't want anybody to walk away from this talk thinking that you can go spend $50 over and over and over and not have to report it. As of right now, every single transaction that you undertake with crypto has reportable components, unless it's, buying and holding or transferring internally. Last but not least, Elizabeth Warren steps up to the plate with the Digital Asset Anti-Money Laundering Act. This moves to align crypto with TradFi anti-money laundering rules, which means KYCs, basically, right? There's a lot of thought placed on KYCs. They want to know, the government wants to know what you're doing. They want to be able to attach wallets to people, essentially, so that they can, track you and know what you're doing. There's also due diligence for high-risk transactions based on size, geography, user profile. This is all the anti-money laundering, anti-terrorism stuff, right? They want to know if large amounts of money are moving back and forth between terrorist states or states with high crime and things like that. Suspicious activity reporting and compliance programs for anti-money laundering at the company or protocol level.